Thanks, everybody. It's been a great couple of days, and we are excited to be the grand finale. I'm Daniel Payne. I'm from Cole-Frieman and Mallon. I'm a crypto attorney specializing in securities regulation. I thought we might start off by just introducing ourselves so I don't shortchange you guys at all. So why don't we start right here with Glenn?
Sure. Hello, everyone. Thanks for taking the time and staying with us. And thanks to Vidak and Beryl Elites for having us here. My name is Glenn Barber. I've been in the digital asset space for a little bit north of 5 years. Head of strategic sales at Lukka. I was running businesses for both Copper, the digital asset custodian, and FalconX, the trading firm before this, and have a background in traditional finance where I was working for a number of banks, including Lehman Brothers, Barclays, and Deutsche. Nice to see you all.
Well, it looks like Vidak saved the best for last. So excited for the panel. I'm Gerald Brandt. I head capital formation at CMT Digital. We were one of the first managers to focus on this ecosystem. By way of personal background, I actually grew up in Brazil. That drove some of my initial interest in Bitcoin. I spent many years in traditional finance around hedge funds and went down the rabbit hole in 2018. So I'm now on my third cycle. So I started like a generation ago, it feels, because things move so quickly. Excited to cover everything that's happening in tokenization and how the ecosystem has been evolving.
Thanks.
Cool. My name is Dennis Crisello. I'm the head of wealth management for Onyx Digital Assets. Onyx is JP Morgan's blockchain business unit. My focus is on asset and wealth management use cases, so a lot of fun tokenization, a lot of exploring the art of the possible. And my background is in building portfolios of hedge funds, private credit funds, co-investments, so very familiar with the pain points of getting invested there and capital calls and all that good stuff, which I'm sure we'll talk about.
Good afternoon, everybody. I'm so glad to be here. My name is Tom Sullivan. I lead business development for digital assets at Societe Generale here in New York, primarily in support of SG Forge. So SG Forge is the digital asset arm of SocGen. It was formed 5 or 6 years ago with the idea of bringing capital markets activity onto blockchain because it should be better and faster and cheaper, and many of the things we'll talk about, I'm sure, throughout the panel. You know, my background is actually in securities and finance operations. I have spent more years than I care to admit doing that work. I got into the space, actually, the story I always tell, and it's true, is through my kids. When my sons I have twin sons who are now 21. When they were 10 years old, this was one of the only things they could talk about, like every day. It was like Bitcoin this, blockchain that. And I knew they were smarter than me, even at 10, so I'm going to listen to them. So that's how I got into it.
That's great. Well, you know, we have a crypto panel because the name of our panel is a made-up word. Tokenization, not a word that anybody was using, you know, even a decade ago. Even after the Bitcoin blockchain was launched, tokenization is even newer than that. So what are we talking about? We're talking about putting assets on a blockchain via a token, and it's all code. It's all code. Now, that's the what, but of course, we're here for something more interesting, and that is the why. What are the benefits of tokenizing assets? Why would anybody want to do this? Is there some demand out there for tokenized assets when there's plenty of other traditional assets that you can invest in? So I wanted to start with Dennis to tell us the why from a high level. What are the biggest benefits of tokenizing assets?
Yeah, I mean, the way we look at things is tokenization really helps with two different things. One is it enables you to do what you already do better, faster, safer, cheaper, all that good stuff. And two is it enables utility of assets. In a lot of ways, you know, the assets that you own today just kind of sit there. You know, you are a row in a spreadsheet at some transfer agent in your money market fund. Can't do a whole lot of things with that today. That's starting to change. But the idea of tokenization is around like what you could do with the asset after the fact. And so that could be borrowing and lending. That could be being able to get liquidity for an illiquid asset. It could be things like including illiquid assets in model portfolios more easily. And then we have like a North Star vision of like what we're trying to do for private equity, which involves, you know, a client commits $1 million to a private equity fund. They put $1 million in a liquid tokenized model portfolio. Capital call comes through. that triggers the redemption or sale of the liquid to fund the capital call. So you don't have an opportunity cost, you don't have the cash drag, and you don't have a phone call from your investment advisor saying, hey, we need to put cash in this account. That's kind of like what we're aiming at.
Yeah, that's great. Getting into this idea of liquidity, and so that would be using smart contracts to get rid of some of the manual processes there, which you can do with tokenized assets. Tom, what kind of liquidity can be created with tokenizing an asset that maybe is missing in a traditional asset class?
Sure. So there's a lot of things that that come to mind. So one in particular, and I know something that JP Morgan has done similar work in the space, is the idea of using assets intraday. So typically, when you think about how when you own an asset, sometimes if you have a margin account, it can be lent out, or if you're at a trading firm, you can lend it out on a stock loan or repo or what have you. Those contracts are overnight to open to term dated out in the future. Using smart contracts and tokenization enables you to do intraday lending to improve the use of not only your collateral availability, so the securities that are tokenized, but also the funds that you have available. And that's super important. And it's a really nascent market, and it hasn't taken off yet. I think that people don't realize the power of that to basically almost double dip in the assets that you have and the way you can both generate revenue and create opportunity. So that's something that we're really excited about. We had done a pilot trade about a year ago or so here in the U.S. with a client. We were able to lend money for an hour or so when they needed it, and so that's something that I hope to I have to see more of. So that's one example, but there are tons. We could go on and on.
Yeah, and just to follow up on that, I've just seen some headlines that some stock exchanges are planning to extend their hours so that you can start trading 5 a.m. and go to 11:30 p.m. Of course, that's in a response to crypto, which trades 24/7. And you talk about being able to make get somebody liquidity when they need it. Sometimes you need liquidity, in non-banking hours, and that's where crypto can really come in.
Yeah, and that's a great point. But one of the dirty secrets there is that trading systems can do it today. I mean, you can trade stocks, around the clock, pretty much, give or take. You can, they're after-hours trading and things like that. It's the infrastructure that sits behind it. So it's the clearance and settlement that takes the time. And when you have integrated infrastructure where you can do that, and that's why when I talk about this stuff, a lot of people talk about the sexy benefits. I talk about the plumbing in a way, how you can fix the plumbing to make this stuff better. And that's one example where the trading part, sure, you can, that's an easy fix, but once it gets handed off to, to clearing and to back office, that's when it takes time. So the U.S., equity market recently moved from a T2 to a T1 cycle, which everybody knows. And, that wasn't super hard, but to go from T1 to T0 is going to be, and the SEC, by the way, I think we said we weren't going to talk too much about regulation, but the SEC, by the way, had asked when they put out the request for comment for the industry to move to T1. It was a 200-page document. The first 70 pages were about T1. The next 130 or so were about T0. That's really where they wanted to get to. But it can't happen. And this is the way to enable the industry to move forward that way.
I would totally agree with everything Thomas said, and I would just maybe add on that it's not the asset side. Like the asset side's not the problem. It's the cash side. Everybody's kind of been in a situation where you send a wire or an ACH and you don't know exactly when it's going to land. And so blockchain and tokenization, with its ability to have multiple types of assets on the same set of rails, including cash, gives you that precision settlement, like down to the minute or down to the second, in many cases that you just don't get with traditional financial infrastructure.
That's great. So, Gerald, we've heard some great benefits of tokenization. What are you seeing in terms of institutional adoption or interest or demand in tokenized assets?
Sure. Well, institutional adoption has really come in a variety of forms, right? If you start off with the end investor side, we've seen the types of institutions allocating to managers in the space like CMT Digital really grow and diversify. Some are more ahead of the curve than others. But I would say that if you look at institutional investment committees today, there is a baseline level expectation that a well-informed view, a studied view kind of exists. And there are still concerns in some cases about, shall we say, lack of regulatory clarity, headline risk. But it's an interesting dynamic because as this space evolves and we do get greater regulatory clarity, I really think that we'll see the switch get flipped, whereby the career risk and the reputational risk will exist for professional allocators who are not basically investing in the space at some level from a portfolio strategy standpoint. So we can start off there. In terms of institutional adoption, of course, we're all familiar with the way, say, institutions like BlackRock have evolved their views. Larry Fink, of course, being a prominent proponent today of the tokenization of financial assets after really kind of starting out as a skeptic, right? So I don't think you will find more institutional grade, so to speak, approval and buy-in than institutions like Fidelity, for example, which if you look at the league table of Bitcoin ETFs by volume is number 2, as well as really, I would say, traditional asset managers like Franklin Templeton that made their names in plain vanilla bond mutual funds that now have well built out blockchain groups. So another level of expectation, I would say, on the institutional banking level is that activity will be taking place. In some cases, like JP Morgan Onyx, I know you have over 200 people and a team that's very broad and deep. And there are a number of others that are really launching really interesting products and projects of different kinds.
That's great. So Glenn, Lukka serves institutional clients. What kind of opportunities are they looking for in tokenized assets, and how is that demand looking in 2024?
Sure, thank you. I think just to add to Gerald's comments, right? I mean, I think one of the biggest benefits of tokenization and the huge ecosystem that it represents is it literally is the bridge between traditional finance and crypto in a lot of respects, or as someone on the panel said, digital and non-digital worlds, right? And what I mean by that is you can have use cases where more traditional institutions, whether in the finance industry or not, get access to tokenization through digital asset ecosystem firms and get a chance to participate in things that they traditionally would not, right? At the same time, there's been a huge interest, and we go back to BlackRock and other traditional financial firms, right, that are allowing digitally native or crypto native firms to participate in money market funds, right? So if you have, regimes where either staking in crypto or other return profiles are not matching up to what you get in the more traditional world in terms of interest rates and risk-free generated returns, right? Tokenization in one large aspect is a bridge that will connect the two worlds together in a much more efficient firm, and that's exactly where the institutions come in. Now, if I go back to your question and I think about Lukka as what we consider to be one of the preeminent data and software firms in the digital asset space, right? What people are looking for, especially institutions, is for it to be easy. Make me a front end that I'm used to, that I can assimilate to, that makes digital assets, tokenization, or anything in the middle look like an equity, a fixed income instrument, or a commodity, depending on what I'm familiar with, right?
Amen.
Right, and so for Lukka, as a particular firm, and obviously we would work with the people on stage and other people, the first thing that comes to mind is normalization, right? Having come from running trading desks in the traditional financial world, even on the program trading side, right? On the global side, we had to worry about whether a client would send in an ISIN, hopefully a CDAL because it's a unique identifier, right? A QSIP, and God forbid you had the wrong currency on it because then you wound up taking risk on behalf of your client. But the bottom line is, even in the more traditional defined space, identifiers can be problematic, right? And then you take firms where you have to issue your own tokens, right? So coming back to it, standardization and normalization of data, identifiers, making sure that each token, right? A token represented by JP Morgan doing the same thing that is represented by Societe Generale might have uniquely assigned identifying numbers by those actual firms, right? Not because they want to make it difficult, because it's just you have to start somewhere. But there's no uniform labeling or coding of a similar token from two different firms. And that is part of the standardization and normalization exercise that I think a lot of institutions would eventually like to see and require.
That's great. That's very helpful on what we're looking for and what we need in order to move the demand along. So now I want to get into some more juicy stuff, not just theoretical discussion of why tokenization or what the institutional demand is like, but what are the actual use cases of tokenizing real assets and seeing those use cases actually make a difference for investors or the issuers or the whole economy. So I want to go down the line, give everybody a swing at this pitch. So Tom, why don't we start with you? What are some of the use cases you're most interested in for tokenizing assets?
Sure. So there are two that I highlight. One is the native issuance of securities tokens, right? So we at SocGen are a big issuer of structured products, and we see an opportunity for the types of data that needs to coexist alongside the structured products to be available through smart contracts and things like that. So in a particular example, last year, about a year ago, SocGen issued a green bond on Ethereum. So it was a public blockchain, and that green bond was tied to some performance measures of SocGen's performance with respect to its green targets. When the bond was issued, there was two components to it. One is that part of it was settled against a native cash token. So SocGen in Europe, such as SocGen Forge in Europe, has a stable coin. It's not available to U.S. persons, so just say that out loud. It's only available to non-U.S. persons because I'm not allowed to market or sell it. But so that transaction settled in 18 minutes. And so you have the combination of features, right, to be able to leverage the technology and smart contracts to improve the data that's available on the green bond, but also to leverage the on-chain money to be able to settle more quickly. So that's one example. And then the other example is something that we've done closer to here, and that's the tokenization of U.S. Treasuries. So we have an application that we use for internal purposes whereby we move collateral around or actually settle repo and U.S. Treasury transactions between our entities. And we did that to be able to get the real-time benefits. So rather than waiting for a bank to open at 8 o'clock in the morning and close at the FedWire closes at 3:30, we can move assets around to our heart's content. But there's a cost component to it. So in using the distributed ledger technology, we're able to save significant dollars by internalizing some of those movements and not relying on external bank movements. So I think that there's the longer term vision of what we talked about with the green bond issuance, but the kind of the again less sexy use case that saves us $1 million a year.
And I don't want to derail this panel, but I'm curious, how comfortable are your regulators with you guys using internal tokenization processes to save money?
So that's a great question, and the simple answer is that when you do this work, you need to do your homework. You need to be prepared to anticipate what the regulators expect. Last year, I believe it was, that the Fed had issued basically a market guidance that firms that were supervised by the Fed needed to notify their primary regulator, i.e. the Fed, when they were embarking on this type of activity. In the case of the repo transactions or the repo platform that I was talking about, we did that preceded the Fed guidance. Nevertheless, that's the first thing, is to have the open dialogue with them to say, hey, before you do it, here's what we're going to do. Are you okay with it? The second thing is that, and in that case, it's different in Europe, but in that case, we're using a private permission blockchain so that it doesn't have access to, so among the concerns you can imagine, or things that they've talked about publicly, are data security, access to bad actors, things like that. So if you're in a permissions chain, it was a much easier, conversation. And we hope that will change over time, but that was a much easier conversation.
That's great. All right, Dennis, some use cases?
Sure. So Thomas definitely stole some of my thunder.
Sorry about that.
All good. We have an intraday repo application as well. We do have this open for external clients. We have about a dozen on board. The types of use cases are basically what Thomas described, where somebody needs funds in short order for different reasons. And so those reasons for us primarily fall into three buckets. One is broker-dealers who have different funding cutoffs they need to hit around the US and around the globe. So they're able to quickly access cash by tokenizing treasuries on our platform so that they can have the required amount of capital. That's one, that's probably the biggest one. The second is we have onboarded some hedge funds recently where the idea there is they use this and the instant and precise settlement features of blockchain to be able to get the maximum length of borrow against their treasuries without having the risk that they won't be able to take those treasuries back and pledge them to CME, for example. And then the last one is probably my favorite example, which is we have some loan servicers on platform, and what they're doing is they have a unique problem where they know that one day a month or a couple days a month, they're going to receive a large lump sum of cash from people paying their interest and principal. They need to turn around and pay out this cash to the owners of these loans, right? And so what they do is to get a jump start on that, they will tap the platform that we've set up for a couple times now. We've done 1 hour, $5 billion loans with cash delivered like within a minute. And the power of that is that because this is not overnight capital for the bank, we're able to offer this at a very reasonable rate of interest, and they also only pay that interest for the 1 hour of usage. So it's kind of a unique use case for them to be able to quickly, effectively stream cash as needed. However, the one use case I spend most of my time on is private equity tokenization. And so here, the idea is that, when you think about alts, they don't really have a home. There's no real settlement, there's no real clearing. You have this general setup where you have a transfer agent or fund admin, a distributor, and a fund manager. Everyone has different systems. They all speak different languages. The data structured very differently across these firms. And so what we're doing here is building a platform where we can consume this information, reconcile it, but importantly, also have cash moving through the application so that compared to today, you get at the source investor level transparency on high net worth individuals funding capital calls, which is a big pain point today because what happens is the fund admin will say for this RIA, you have 600 investors, they owe $10 million. The RIA will scrounge up the money from their investors. They usually don't end up with the 10 million. Somebody's late, somebody needs more time, and there's a lot of back and forth around who actually funded this thing. And using blockchain tokenization, this instant settlement feature gives you that transparency so that you know exactly the state of who owns this token now, and it's shared with the entire network of participants. So that's what I spend most of my time on.
I don't think I stole your thunder at all. I think that your use cases are similar, but super interesting. So
Yeah. All right, Joe.
Sure. So, just to take a step back on the evolution of tokenization and decentralized finance, part of our thesis at CMT Digital is that we believe decentralized finance will be as impactful and transformational towards TradFi as the internet was for information exchange. Now, we've backed over 160 early stage companies and projects in the space. If you look at kind of the original types of companies that VCs were backing in the space, these tended to be infrastructure plays, exchanges, companies delivering payment solutions. Those remain important core themes. But if you look at the early days of decentralized finance and the intersection between DeFi and tokens, this really began kind of like a utopia on a whiteboard before real use cases got built out. In the early days, you had a few platforms like Uniswap that was offering a decentralized exchange solution, a few decentralized lending platforms like Aave and Compound. Fast forward to today, and the diversity of use cases and their underlying fundamental value in terms of their business metrics and the total value being locked has really grown in an exponential way. I can give a few examples. There's a platform called Centrifuge, which is an on-chain securitization platform. It's basically driven partially by smart contracts, which you can think of as programmable money, and it effectively is a means to reduce costs and inefficiencies of the traditional analog Wall Street securitization process. And investors ultimately benefit from that because this is the kind of solution that can reduce latency. So Centrifuge is an interesting example of a live platform, and the smart contracts are doing what they're supposed to be doing. One theme that we are very constructive on is DPIN, or Decentralized Physical Infrastructure Networks. A standout portfolio company that we've backed is Helium, which some of you may be familiar with. Helium is what you can kind of describe as a decentralized Wi-Fi or telecommunications solution where the community of users is rewarded by a token incentive for providing Wi-Fi connectivity to the public. And it's a project that has really achieved critical mass, product market fit. We spotted meaningful founder market fit when we originally invested in this company. And I think it's very much aligned as a company with some of the core tenets of blockchain technology, such as disintermediation and so on. So 2 examples right there.
Great examples. Glenn, what do you got for us?
Look, I think the panel's hit the nail on the head. And just to summarize, my 3 things are exactly what have been brought up, right? I think, number 1, tokenization brings better access, right? So go to Dennis's point, whether it's private equity funds. Usually the purview of very wealthy clients, right? If you have a fund that only accepts $1 million check, well, with tokenization, you can break it down and allow your investors, subject to the right regulatory requirements, maybe $20,000 parcels, right? Not speaking for everyone, but $20,000 in an investment's a little bit easier to come up with than $1 million, right? So whether it's JP Morgan's private equity funds, whether it's a digitally native firm like Securitize, for example, making hard to reach investments or illiquid investments, art, wine, and the like, available to many, many more investors, and hopefully eventually someday with the right protections down to normal investors like everyone up here. Access is number 1, right? Number 2, to go back to, I think it was Thomas's point, collateral movement, operational leverage, right? You have the ability to use stuff that's just lying around and use it for better purposes, right? If you have treasuries posted somewhere and they're lying dormant in an account, maybe getting swept for incremental return, why can't I leverage that stuff on my balance sheet and say, I'm going to post these as collateral, keep my return unless they're taken away from me, but use that for something else, right, as collateral. And then the third thing I would say on Gerald's point, right, added return. Even on stuff that we might not even think about. If I can use my phone and my unused Wi-Fi and donate it to Helium for added return, or if I take the Filecoin example where I have, unused storage space on my laptop or my desktop at home, I can basically give it to someone that is looking to, provide that service to someone else who's willing to pay for that unused storage space. I can make a return on effectively a dead asset that no one even thought was an asset in the first place, right? So just to sum up, I think these were great things, right? Much more access, much more operational leverage, and even some true leverage in terms of what we know in terms of pledging securities and collateral, and added return on things that we probably never even would have considered.
So these are fantastic use cases. I'm getting excited hearing about them. I'm sure the people in the audience are excited hearing about them, but I'm sure we're all in agreement. These use cases have not gone viral. They're not widely adopted. There's plenty of dead assets sitting around on people's phones, on their computers, and they haven't unlocked the value, even though the ability to do that is now here. So this is a toss-up for the panel. Anybody can grab it. I don't want the answer of marketing, but what is the biggest or the top 2 or 3 hurdles that we've got to overcome to get widespread adoption to these fantastic use cases?
That's a great question. I'll take a quick stab at it. Clearly, the regulatory side that affects tokenization is very key. And regulatory clarity, like the fundamentals of these projects, is trending in a very positive direction. Of course, we have an election a week from now, and clarity in terms of both administrations' policies towards the space is very positive. I think regardless of the outcome of the presidential election, both candidates have been very constructive in terms of their views on the space. Then if you look at Capitol Hill, very meaningful advancements in areas like regulation of stable coins, growing bipartisan support. So that's going to be, I think, very positive in terms of just the overall engagement and connectivity in the space following well-established norms in the US. And the US is really in catch-up mode in many ways, because if you look at other geographies, Europe and the UK, for example, have more established legislation related to this space. I'll give you another example. My native Brazil has the central bank backing of a tokenized real estate market on a national basis, whereby real estate transactions are primarily done on the blockchain with not only regulatory approval, but encouragement. But I'm confident now that things will be trending in the right direction in the US, and we'll catch up.
So maybe one of the things that I'm just kind of listening to these guys, I think that we almost suffer from the problem of there are too many good ideas. There are so many good projects and so many good things that it's hard for stuff to bubble up and to be windows or whatever. And I think that's going to happen. It just takes time. And one way that's we're seeing that is through collaboration and consortium at scale. So our firms are part of a project that Monetary Authority of Singapore has launched earlier this year called Global Layer 1, and that has brought large institutions together to work to deploy applications and assets on blockchain globally. And I think that's something that just to start, that's kind of one example. The regulatory thing is certainly a topic that people like to stay away from, but it's true. There's in Europe, there's MiCA. It's enabled progress in a way that hasn't happened here yet. So I have the pleasure of serving on a committee sponsored by Commissioner Carolyn Pham of the CFTC, the Global Markets Advisory Committee. There's a Digital Asset Markets Subcommittee, so it's a lot of letters and words there. But one of the things that we've written a recommendation, and we're hoping this is going to go to the full commission either this month or later next month, is to leverage tokenized collateral. So maybe taking assets in tokenized form and to use them to deploy them as collateral for variation margin, initial margin, or what have you. And the basic premise of it is that it's allowed. We can do it now under existing law. There's no additional legal writing that needs to happen. The wrapper doesn't matter, and that's so the commission needs to acknowledge it. But we've done a fair amount of work in that space, and I think that it's clear. Now, the last thing I'll say, and this leans into what Glenn said is custody earlier, is custody. And I think that one of the key enablers for institutions to move forward is having larger institutions in particular to have their user experience be the same when they invest in U.S. equities or they invest in digital assets. And that's something that hasn't happened yet, and that'll be an enabler for things to really move.
Yeah, and maybe add a couple things. Maybe I'll start with what's not holding us back. It's the technology. Like tokens work, blockchains work. We have enough proof points to understand that this actually is a thing and does create benefits that everyone's talked about here on the panel. I think like when we think about the amazing set of use cases that we have and we're focused on, a lot of times it's just getting the right people around the table and everybody aligned. So like the example I gave before of the private equity token thing, that can be applied to anything, but you need to get like a distributor at the table, a fund manager, fund administrator, the technology provider. And a lot of times that and like threading the needle between everybody's incentives is challenging. And so I think when you get that and you get these real tangible proof points around here's how much we saved, here's how much revenue we added, then I guess this kind of gets into marketing a little bit, but like that's when this becomes really powerful. When you have like these tangible things that you could point to instead of, so like there's a lot of noise in this industry, and so like cutting through the noise with these real examples I think is really important for making this mainstream.
Yeah, and I think, look, most things in this world come down to supply and demand, right? There's plenty of supply in tokenized projects. We just haven't found the right demand. And as I know you said it, you told us not to use the word marketing, but if you don't have enough demand, it doesn't matter how much supply you have, right? So I'll take myself as an example. I agree with Gerald, right? It should be an easy thing for me to say, crap, I've got pretty good service on my phone in New York City. I should lend out my unused Wi-Fi, right? But am I gonna walk out this door and that's the first thing I'm gonna do? I don't know much about it. Is it safe? Are people gonna steal my data, right? With unauthorized access? Do I trust Helium? All of this comes down to the educational component. And as Thomas said, we have so many great ideas. And obviously, usage of phone or computer storage does not necessarily conflict with better financial optimization, right? But at the same time, we have not yet found, one, the demand to hit critical mass, and two, we also need the distribution methodology to be a little bit more seamless. Once we have those things, I think the demand will come over time, and we will look back in 10 to 15 years and go, holy cow, how did we get here without any real big bang sort of milestones? And we'll just take it for granted and wonder what the next thing that's going to come by is.
All right, we're going to try to sneak in one more question. I'm going to let everybody take a quick shot at it because we're running low on time. So you get 45 seconds. And let's assume that these hurdles are met and that we start getting widespread adoption of people getting involved in these different use cases for tokenized assets. How is that going to transform our economy when we're relying on investments in tokenized assets and we've moved away from what we now think as TradFi, and we have a new TradFi, which is blockchain based. What does the future look like in 5 to 10 years? In 45 seconds.
Look, I'm just going to go with the obvious, right? And use the word stablecoins. In my mind, stablecoins are the perfect example of tokenized assets, right? It's the tokenized US dollar for our country. It could be euro, it could be yen. The fact that I can zap something from my phone or from my desktop to someone else anywhere in the world without having to send a wire, and to someone's point earlier, maybe it was Dennis, you don't know when it's going to hit. You don't know when the account's going to get credited or debited. I can do this faster, cheaper, more expediently, and 24/7. Love that stuff. And it's going to erase a lot of the friction in the financial world today in less than 5 years. Perfect example, I think I saw reports that if anyone's used Airbnb, right, especially if you're a renter as opposed to a rentee, you can now get paid a lot faster, and even on weekends, by someone like Visa that's using tokenized stablecoins. Why? Because they can drop the stable coins in your wallet a lot quicker and not have to wait till Monday till the bank opens, right? Beautiful use case for users of Airbnb.
Great. Gerald?
Yeah, I fully agree with the point about stable coins being, kind of a core use case that has transformational potential on a going forward basis. I would also say that the tokenization of property rights of different kinds, is going to be very powerful in terms of creating efficiencies. And I would also say that if you look at the future of money and the future of finance and creating more equitable distributions of outcomes, that's going to be a very positive societal factor of this type of technology as well.
Great. Dennis?
Yeah, I would point back to the work that we did last year with the Monetary Authority of Singapore and Project Guardian around what portfolios of tokenized investments would look like for your retail investor. And what we found is that because it's so much more efficient, you're taking roughly 3,000 steps of rebalancing, collapsing it into a few clicks. Because it's so much more efficient, you are able to get this level of hyper-personalization. And because you have cash and assets on the same set of rails, you could potentially eliminate cash drag entirely. Like anybody who runs a portfolio is going to keep some level of cash. Like you don't necessarily have to do that. And that's an instant benefit to your end investor. plus the ability to potentially include alternative investments and get a better, higher quality portfolio from that angle as well.
Oh, now you stole my answer. I like the hyper-personalization. No, so I agree with that. I agree with the stablecoins. I think that there's going to be stablecoins 2.0 or 3.0 when you have more utility and not just the creator of the stablecoin getting all the yield. So I think that there's a yield component that's going to change. I think the panel yesterday talked about that. And then I think there's also, so there's going to be new markets with respect to things we talked about before about intraday use of collateral and liquidity. But there's going to be a lot of stuff that just changes and people don't notice or don't care. And that's what's most important is with 5 to 10 years from now, the 4 of us will not be up here talking about this at all, and that'll be a good thing because it just happened.